Hello everyone, welcome to Finance Insight. I'm Tony, and today, we're embarking on an exciting journey into the heart of financial markets, the stock market. Whether you're a curious beginner or someone looking to deepen your understanding, you're in the right place. In this video, we'll simplify the intricacies of the stock market, beginning with the basics, and navigating through its history, significant events, and Hollywood's portrayal of this dynamic world in movies. So, what is the stock market and how does it work? The stock market, often referred to as the epitome of capitalism, is a financial hub where ownership shares of publicly listed companies are bought and sold. Its roots can be traced back centuries, with key milestones shaping its evolution. Now you may be asking, how was it created? Well, in the 17th century, the Dutch pioneered stock trading with the establishment of the Amsterdam Stock Exchange in 1602. Fast forward to 1792, the New York Stock Exchange was born, becoming a symbol of financial prowess and a key player in the global market. Okay, but how does a company enter the stock market? Companies enter the stock market through an initial public offering, IPO, issuing shares to the public. Investors, both institutional and individual, trade these shares on stock exchanges such as the NYSE or NASDAQ. Brokers act as intermediaries, facilitating these transactions. Now, how does the stock price change? The dynamics of stock price changes revolve around the fundamental economic principles of supply and demand within the stock market. When there is a surge in demand for a particular stock, meaning more investors are looking to buy it than sell it, the stock price tends to rise. This upward movement is a result of increased competition among buyers, each willing to pay a slightly higher price to secure ownership of the stock. Conversely, if there is a higher selling interest compared to buying interest, the stock price experiences a decline. When more investors want to sell a stock than buy it, the market becomes saturated with sellers, leading to a situation where buyers have the advantage in negotiating lower prices. This increased supply relative to demand exerts downward pressure on the stock price. In essence, the stock price is a reflection of the equilibrium point where the intentions of buyers and sellers intersect. It's a dynamic interplay influenced by various factors, including market sentiment, economic indicators, and company performance. Traders and investors closely monitor these shifts in supply and demand, utilizing them to make informed decisions on when to buy or sell stocks in pursuit of financial gain or risk mitigation. Understanding these fundamental principles is crucial for anyone navigating the complexities of the stock market. Okay, but who participates in the stock market? Various players shape the stock market dynamics. Investors trade based on their strategies. Brokers execute trades on behalf of investors. Market makers ensure market liquidity. Regulators like the Securities and Exchange Commission (SEC) oversee fair practices. But how do investors make money? Investors employ various strategies to capitalize on their investments, primarily focusing on two avenues for generating profits: capital gains and dividends. One of the primary ways investors make money in the stock market is through capital gains. This occurs when they sell a stock at a higher price than the one at which it was initially purchased. Essentially, investors aim to buy low and sell high, taking advantage of fluctuations in the market. The difference between the purchase price and the selling price once the stock is sold constitutes the capital gain. Investors often engage in careful analysis of market trends, economic indicators, and company performance to identify stocks with the potential for appreciation over time. Another avenue for generating income from investments is through dividends. Dividends are periodic payments made by some companies to their shareholders, typically from a portion of the company's profits. These payments are distributed either in cash or additional shares of stock. Dividend-paying stocks are often considered stable and can provide a regular income stream for investors, making them particularly attractive for those seeking a more consistent return on their investments. Investors often tailor their investment strategies based on their financial goals and risk tolerance. Some may focus on stocks with high growth potential, aiming for substantial capital gains, while others may prefer the stability and income provided by dividend-paying stocks. Okay, but what about Hollywood? The stock market has been a captivating theme in cinema, offering glimpses into its exhilarating highs and devastating lows. Take for example the movie, The Wolf of Wall Street, that portrays Jordan Belfort's rise as a charismatic stockbroker, achieving wealth through fraud and excess. The film delves into his lavish lifestyle, legal troubles, and the ultimate downfall of his financial empire, offering a gripping portrayal of the darker side of Wall Street. Thank you for joining us today. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more educational content. Until next time, happy investing.